Hi, I'm John Persinos, Editorial Director of Investing Daily. To view our full range of products and services, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. At the annual Jackson Hole Symposium last week, Federal Reserve Chair Jerome Powell delivered a speech that sent shockwaves through the financial markets. Strongly suggesting an interest rate cut is imminent, Powell's message resonated with investors who are now fully pricing in a reduction when the Federal Open Market Committee, FOMC, meets on September 17 through 18. This anticipated move marks a significant shift in the central bank's stance, providing a catalyst for further market growth. Take a look at the following chart. Stocks in the U.S. and in developed countries overseas finished last week in positive territory and currently hover near all-time highs. Treasury yields have been falling. The Dow Jones Industrial Average, S&P 500, NASDAQ, and Russell 2000 are all trading well above their 20, 50, and 200-day moving averages, signaling robust momentum. This price chart shows the Dow's ascent. This trend signals optimism over economic growth as industrials and other cyclicals stand ready to benefit from lower rates. As you can see from this chart, the S&P 500 has been on the rise as well, a sign that the broader market is benefiting and not just a handful of tech megacaps. That said, as you can see here, the NASDAQ also hovers near record highs, which in turn tells us that technology stocks still have plenty of fuel left. And as you can see here, the small-cap Russell 2000 has exhibited similar momentum, a clear indication of economic optimism. Small caps tend to perform well when the economy is thriving. Healthy market breadth is confirmed by the rise of the New York Stock Exchange Advanced Decline Line, the NIAD. The rise of the NIAD signifies that more stocks are advancing than declining, pointing to a healthy and broad-based rally. A market rally with strong breadth is often more sustainable, indicating that the upward momentum is not confined to a few sectors, but rather spread across the market. The optimism surrounding a potential rate cut has had ripple effects across various asset classes, notably crude oil. With expectations of a stronger economy and increased energy demand, oil prices spiked on Powell's remarks, although they were slightly down for the week. Investors believe that lower interest rates will stimulate economic activity, leading to higher consumption of energy and commodities. As you can see here, the CME Group's FedWatch tool tells us that Wall Street is betting on a rate cut next month. It is a critical mistake for investors to let political rhetoric dictate their market strategies. A perfect example is former President Donald Trump attributing a one-day stock market slump to what he termed the, quote, Kamala crash. The markets rebounded the very next day, illustrating the folly of making knee-jerk reactions based on political headlines. The key to successful investing, especially during a tumultuous election season, lies in adhering to technical indicators and solid fundamentals. The fundamentals remain strong. Corporate earnings for the S&P 500 are projected to come in at a robust 10% year-over-year growth for Q2 2024, underscoring the health of American corporations. Meanwhile, inflation, as measured by the Consumer Price Index, the CPI, has been on a downward trend. The forthcoming release of the Personal Consumption Expenditures PCE Index on Friday, August 30, will be crucial. The PCE is the Federal Reserve's preferred inflation gauge, and if it shows a continued decline, it will further solidify the case for a rate cut next month. Now let's take a look at the week ahead. These are the major economic reports scheduled for release in the coming days. Durable goods orders Monday, S&P Case-Shiller Home Price Index Tuesday, initial jobless claims pending home sales Wednesday, PCE and consumer sentiment Friday. Given Powell's statements and the market's current trajectory, the bull case is firmly intact. Investors would be wise to position their portfolios to benefit from economic expansion and lower interest rates. Sectors that typically outperform in such an environment include industrials, small caps, technology, utilities, and real estate. These areas are poised to capitalize on increased economic activity and the positive impact of cheaper costs to borrow money. Well, that's it for now. Thanks so much for watching. And if you have any questions or feedback, please don't hesitate to send me an email at mailbag@investingdaily.com.